Assalamualaikum and warmest greeting everyone. Welcome back to my channel. I am Madam Yusnaliza. In today's presentation, we're going to learn on how to answer the question which is from May 2024 Common Test FAR270, and this is questions 2. So let's start with part A, the first one. If you look at the requirement, you have the requirement which asks you to state whether or not the above respective asset would be recognized as investment property as per Mfrs 140. So we have to answer whether it is an IP or not an IP. The following descriptions of asset items for Wonder Friends Berhad, a company involved in producing futuristic gaming gadget. Number 1. A special machine rented out on operating lease agreement to Park JT Enterprise. So it's a machine, so it is not an IP. So this is not investment property because it is a machine. Number 2. Number 2 is where you have a 20-story building of which 2 stories are occupied by Wonder Friends, which means that is owner occupied. 2 stories are owner occupied, and you are also informed that other 18 stories they are being rented out to SLGM under operating lease. However, you are further informed that the building cannot be sold separately. So if the building cannot be sold separately and the owner occupied portion is insignificant, the whole 20 stories building will be recognized as IP. So this is an item of IP. Next one. The land acquired at Namsan Precinct to be used in future as parking lot for a company. So the intention is to be used for parking lot. So which means that in the future it will have a purpose which is as a PPE function. So that is again not an IP, not investment property. Next one, number 4, an old building which was used as hostel for the employees but recently has been renovated and currently rented out to Hy-B. So it was used as a hostel for employee. It was in the past, but recently it has been renovated and now they are rented out to Hy-B Berhad. So if it's rented out to the third party, which is not employee, which is not the staff or the directors, these are an IP. So this is an IP. You must make sure that you read the questions until the end. Next. The land located at Perdana Avenue has been decided to be leased out on a 20-year operating lease. So land to be held as in the future, which is now to be held on a lease for 20 years. This is actually an IP. Okay, there are 2 not IP and 3 IP. Next one. We go to the next question, which is on the divided into 2, this question, which part A is explaining the accounting treatment for a building with the name located at Arryn Capital, and the second part is to prepare journal entry for another building located at Riverdale Street. So we'll do the first one first, which is A, then we proceed with B. So let's just read things regarding A, which is the first paragraph, first 2 paragraphs. The privilege acquired 2 properties on 1st of July 20x 2022. So this is the date of acquisition for both building. So I put it red. 1st July. The following are the details of the 2 properties. There are 2 properties, remember? Okay, we start with Arryn. For Arryn, it was located, it's a 25-story building, of which 2 stories are used for office. So this, which means that these 2 stories are owner occupied, OOP. So that was owner occupied. And the other 23 stories, they are held for rental, and that was rented out to a computer company. The initial cost of the building was 5250, and then you have incurred some directly attributable cost of 800,000 for the renovation cost as well. Then you can see that that was added to the purchase price or the initial cost. Next, for the financial year ended the 30th June, the building was valued at 7890. So this is the fair value of the building by the end of the year. And you are informed at the bottom here, a fair value model was adopted for investment property. Fair value model for investment property, it was fair value model. So this is an important thing that you need to take note. So here, if you are asked to explain for the building in Arryn Capital, what are the accounting treatment of the 25-story building at Arryn Capital. So in Arryn Capital, you can see that 2 stories are used for owner occupied, which is insignificant as compared to the stories that are being rented out. And furthermore, you are informed at the bottom here that properties of privilege cannot be sold separately. Because of this, the whole building, the whole 25-story building, will have to be accounted for as investment property. The reason is because it cannot be sold separately, and also due to the fact that the 2 stories out of 25 stories are insignificant. So let's look at the answer here. So according to Mfrs 140, the accounting treatment for building with dual use or with dual purpose depends on whether the building can be sold separately or cannot be sold separately. As I mentioned earlier, the building cannot be sold separately. And again, the owner-occupied portion is insignificant as compared to the portion held for rental. And because of that, the whole 25-story building will be recognized as investment property for the year ended 30th June 2024. And by the end of the year, 25-story building will be recognized at 7890. 7890 here is the fair value given in the question itself. And before that, the 25-story building here, in the at the beginning, the initial cost was actually given here, 5250 plus 800,000. That is the initial cost. And if you compare this initial cost with the fair value, you will have a gain on change in fair value, which is 1840 by 31st December 2020. What was the date? Let us check the date. By 30th June 2024. It is 30th June 2024. So that was 30th June here. So therefore, it will be recognized in the SOPL. Right. So that is to be recognized as investment property. And for that year ended 30th June, it has to be again being fair value. Right. That was for the first one. Let us look at the second one. This is the second building, which is building that Privilege has decided to convert on 30th of June 2023. Office building, which is an owner-occupied building at Riverdale. Right, it is now to be converted to be rented out to interested vendor. So that was the intention or the purpose of the building now. So there is a change in use. and that which means that there is a transfer from owner occupied portion, which is owner occupied property, into rented out property, which is a transfer from OOP PPE to IP. Immediately, the company managed to get tenants for the office space, meaning that immediately on 30th of June, on that date, the building has a carrying value of 6.5 million. So this is the carrying value on the date of transfer. And remember, for the building, which is as a PPE, the company adopts a revaluation model for its property, plant and equipment. And the fair value as on that date is 9450. On 30th June 2024, the building has a market value, which is the end of the year. After a year, it has a market value of 11 million. So the first thing that we need to do here is to find out what is the carrying value on the date of transfer. So the carrying value on the date of transfer here, I put here CV on the date of transfer. Date of transfer is the date 30th June 2023. It is given there to be 6.5 million. 65. Okay. Then you have the next information. You are informed that this is using revaluation model. Regardless the model used, as it was a PPE, either revaluation model or cost model, on the date of transfer, it must be revalued on the date of transfer. So therefore, you are going to compare the carrying value on the date of transfer with the fair value on the date of transfer, which is given also there to be 9.45 million. Okay, 9450. And therefore, the difference between the two, this will be treated as revaluation surplus, because fair value is more than carrying value. And this is regardless whether on subsequent measurement the building as a PPE uses revaluation model or cost model. On the date of transfer, it must be revalued. And the difference here is 2950. And if you look at the requirement, the question asks you to show the journal entry. And this is going to be your first journal entry, which is to record the revaluation surplus on 30th of June 2023, where you are going to debit your office building, which is as your PPE, and you're going to credit your ARR. So we're going to do that I'll show that in your answer later. Right, so I just do the working first, then I'll show you the journal. Next one is, you are also informed that this is the fair value on the date of transfer. The fair value on the date of transfer here, which is 9450, will be the deemed carrying amount or deemed carrying value of building, the building here as IP. Of building as IP. So from the date 30th of June, it is no longer an item of PPE, it will become an IP, and this will be the carrying value of building as IP. The next one, you have also been informed that by 30th of June 2024, there is a fair value assessment done, which means that you are now going to see that the deemed cost just now, deemed cost of IP, earlier it was 9450. You will now have to compare with the fair value given as at 30th of June fair value given as at 30th of June 2024. And if you compare that, the amount is 11 million. If you compare, you will see a difference, and that difference is going to be your gain on fair value change. And this gain on fair value change is 1550. So this is going to be recorded in the SOPL. So that will be recorded in your SOPL. Okay, so let's see our journal entry in our next part. So let's see the journal entry for the item that we have just done. So the first entry is to record the revaluation reserve that arise due to the on the day of transfer, where the building was using revaluation model and there was a revaluation surplus. So building is being debited, while it was the item here is the building as PPE is being debited, and the asset revaluation reserve is being credited. The next one is to do the reclassification. On 30th of June, the building is no longer a PPE, so building has to be transferred. You have to now close the account. So 9450 is actually the amount that you have been given as to be the deemed cost of the IP, so 9450, and it will be debited to the building as IP. The next journal entry is for 30th June 2024. Remember, there was a fair value gain on change of IP, comparing the IP's fair value as at 30th June 2023 with the IP's fair value as at 30th June 2024. You have a fair value gain of 1550, and that is going to be debited to the building and credited to the gain in fair value change in the SOPL as their income. With that, that's it for today's presentation, and I'll see you when I will see you. Assalamualaikum, and have a pleasant day ahead.